Enterprise Finance Daily Banking, Risk, and Corporate Market Insights. Daily AI-powered insights for finance professionals, investors, and enterprise decision-makers. In corporate finance and banking, central banks and major institutions signal shifts in strategy even as they demonstrate resilience in challenging economic conditions. The U.S. Federal Reserve is setting a careful tone. Officials have moved away from any easing bias, indicating that no interest rate cuts are expected this year, and even leaving the door open for possible rate hikes later in 2026 if inflation remains elevated. The Fed's stance reflects robust economic data like strong job growth and persistent price pressures, which have kept inflation above target levels. Despite the higher borrowing costs now facing corporations and banks, the banking system appears to be on solid footing, with last year's stress tests showing that 22 of America's largest banks could weather a severe hypothetical recession and still maintain healthy capital buffers. Regulators are set to publish new bank stress test results on June 24th to further prove the industry's resilience to worst-case scenarios, underscoring the improvements in risk management after challenges faced by some lenders in recent years. These indicators suggest that major banks remain prepared to support corporate financing needs and navigate an evolving monetary landscape. Forbes. +1. U.S. News. +1. U.S. News. Internationally, major banking deals and consolidation efforts are making headlines as lenders pursue scale and strength. In Europe, Italy's largest bank Intesa Sanpaolo made a surprise move this week by launching a bold €30.6 billion, about $35 billion, bid to acquire Monte dei Paschi di Siena, MPS, one of Italy's storied but struggling banks. This unsolicited offer outflanks a rival merger proposal from competitor Banco BPM and could create the Eurozone's second-largest banking group by market value, potentially trailing only Spain's financial giant Santander. If successful, the Intesa MPS combination would boast an estimated market capitalization of €126 billion and ambitious profit targets, reshaping the European banking landscape. The bid reflects renewed momentum in European banking sector consolidation, as institutions look to build scale, improve efficiency, and better compete globally amid intense regulatory scrutiny and technological disruption. Global Banking Ganfins. Global Banking Ganfins. +1. At the same time, corporations worldwide are adapting their financing strategies to support growth in an era of higher interest rates and rapid technological change. Corporate treasurers and CFOs are pursuing new approaches to ensure liquidity and fund major projects despite elevated borrowing costs. One strategy has been to seize windows of market stability to lock in financing before further rate adjustments, given central banks' evolving stances. Many companies are also navigating increased shareholder expectations for investments in innovation, from clean energy to artificial intelligence, AI, necessitating significant long-term capital commitments. The overall corporate funding environment remains active and optimistic, reflecting confidence that current financial decisions will drive future growth in a changing world. Subtopic: Corporate Finance and Banking, Tech Titans Bond Bonanza. An unprecedented wave of corporate bond issuance reveals how technology giants are financing the next frontier of growth. In 2026, analysts project U.S. companies will raise around $2.46 trillion via corporate bonds, an 11.8% increase from last year, driven largely by massive capital expenditures in technology and digital infrastructure. In particular, 5 leading hyperscaler tech companies, Amazon, Alphabet, Google, Meta, Microsoft, and Oracle, have dramatically ramped up their borrowing to fund new AI supercomputing and data center capacity. These 5 firms alone issued approximately $121 billion in U.S. bonds last year, a quantum leap from the $28 billion per year average they borrowed earlier this decade. Banks like Barclays and Bank of America expect the big tech issuers to continue borrowing heavily, potentially around $140 billion annually over the next few years to support their ambitious expansion plans. This surge in supply has widened credit spreads as investors seek protection against possible risks, but it also underscores a resounding optimism in tech-driven growth and innovation. The willingness of markets to absorb record-breaking debt offerings to fund AI and frontier technology projects highlights how corporate finance is boldly fueling a future that reaches for new horizons. Fidelity. +1. Fidelity. In fintech and regtech, the global financial technology sector is buzzing with innovation and growing mainstream influence, even as regulators race to keep up. Around the world, fintech companies, ranging from payments and digital banking startups to cryptocurrency and regtech firms, are attracting major investments and partnerships that blur the lines between traditional finance and cutting-edge tech. For example, Egypt recently celebrated the rise of its first fintech unicorn, MNT Hallan, which reached a $1.4 billion valuation after securing a new funding round led by Al Ahly Capital, the investment arm of Egypt's largest bank. Such milestones show how legacy banks and fintech innovators are increasingly collaborating, bringing digital financial services to emerging markets and new customer segments. Global fintech conferences like Money 2020 Europe are spotlighting trends such as the rise of stablecoins for cross-border payments and the emergence of agentic AI systems, indicating that stablecoin-based payment infrastructure and AI-powered financial agents are coming to the forefront of the industry's future. Fintech news. +1. One of the most striking developments bridging fintech with conventional finance is the mainstream adoption of blockchain-based digital currencies in the payments industry. In a move that grabbed headlines this week, remittance giant MoneyGram announced the launch of its own US dollar-pegged stablecoin known as MGUST. This blockchain-powered token, introduced at a major industry event in Europe, is designed to serve as the connective tissue for MoneyGram's global network, enabling near-instant, low-cost transfers of value across borders. Customers will be able to hold and send MGUST through the MoneyGram app's digital wallet, giving families and migrant workers a stable, dollar-backed balance for remittances in markets where banking access is limited. This strategic push by a well-known legacy payments provider highlights how established financial institutions are embracing crypto and blockchain technologies to modernize their services, aiming to reach billions of unbanked and underbanked people worldwide. Yahoo! +1. At the same time, regulators are actively reshaping policies to supervise fintech innovations and ensure stability in these fast-evolving markets. The United Kingdom's government, for instance, is scrutinizing its approach to stablecoin regulation. A House of Lords committee has warned that UK rules for digital currencies risk falling behind those of the US and EU, urging policymakers to speed up efforts in crafting a comprehensive regime for stablecoins. Across the Channel, the European Central Bank, ECB, has charted key milestones for an integrated reporting framework, IREF, to harmonize bank data reporting across Europe by 2031. These initiatives illustrate how, even as financial technology breaks new ground, authorities are working in parallel to update regulatory frameworks, unify compliance standards, and balance innovation with risk management in the digital era. Fintech. +1. Fintech. +1. Subtopic: Fintech and regtech, the stablecoin rulebook race. The global rise of stablecoins is forcing governments to rewrite their financial rulebooks. In the UK, a high-profile parliamentary inquiry recently concluded that Britain's proposed stablecoin framework may be lagging behind global counterparts, prompting calls for immediate regulatory action. Lawmakers led by Baroness Noakes have urged the Bank of England, BoE, and the Financial Conduct Authority, FCA, to accelerate stablecoin rules, warning that delays could leave the UK behind the US and EU in shaping digital currency markets. Areas flagged for reconsideration include strict limits on stablecoin holdings by individuals and restrictions on commercial banks issuing their own stablecoins, which critics say might stifle innovation. The UK review emphasizes that regulation should encourage innovation while mitigating risks, ensuring Britain remains competitive in a world where US dollar-based stablecoins dominate crypto transaction volumes. It also calls for stronger measures to combat illicit finance through private digital wallets, reflecting growing official concern over cryptocurrency misuse and the need for robust oversight. As global authorities from London to Brussels refine their policies, the race is on to harness the benefits of fintech and stablecoins without compromising financial stability or consumer protection. Fintech. +1. In risk management and insurance, the financial world is grappling with an unprecedented convergence of traditional and emerging risks, from economic shocks to climate disasters to digital threats, requiring new levels of vigilance and innovation. Financial regulators are leaning heavily on risk management frameworks to safeguard the system in an uncertain climate. Major banks have bolstered their defenses, as evidenced by U.S. stress tests. In 2025, regulators found that 22 of the biggest banks could absorb huge losses in a hypothetical severe global recession and still maintain strong capital ratios. Building on that, the Federal Reserve this week set June 24th for the release of its 2026 bank stress test results, further demonstrating how much emphasis authorities place on robust risk controls and transparency in bank capital planning. This proactive approach comes in response to earlier banking sector turmoil and rising interest rates, as institutions aim to reassure markets and depositors that they can weather potential economic storms with fortified balance sheets and improved risk governance. U.S. News. +1. The insurance industry is contending with a crisis at the intersection of climate change and risk management, as increasingly frequent disasters strain the traditional model of insuring homes and businesses. After tallying a staggering $80 billion in insured losses from natural catastrophes last year, some major insurers have begun scaling back coverage in high-risk regions. Coastal states like Florida, battered by successive devastating hurricanes, and wildfire-prone California have seen a number of big insurers limit new policies or withdraw entirely, leaving more residents dependent on state-run last resort insurance pools. The exodus is driving skyrocketing premiums, with Florida homeowners now paying nearly 5 times the U.S. average for insurance, and Louisiana and California not far behind. Industry experts say the surging costs and shrinking coverage are directly linked to worsening climate risk, forcing both residential and commercial real estate deals to collapse when buyers simply cannot secure affordable insurance. Insurers, under pressure to remain solvent, face a tough choice: drastically raising rates, dropping high-risk policies, or pulling out of certain markets altogether. Policymakers in the hardest-hit states are exploring reforms, from legal changes to entice insurers back, to letting companies charge rates that reflect rising risk, in hopes of restoring some stability to these markets. CNBC. +1. As threats evolve, risk managers are expanding their playbook to address new kinds of uncertainty, including technological and geopolitical risks. Heightened cyber risk is one growing focus. Security and insurance experts have noted an upswing in sophisticated cyber attacks, particularly those leveraging AI, pushing the industry to innovate with solutions like parametric insurance and catastrophe bonds. The emergence of AI-driven threats has even given rise to next-generation risk mitigation startups. One such autonomous cybersecurity platform, for example, just secured $37 million in funding with the aim of identifying and closing novel, weaponized AI attack vectors before hackers can exploit them. Companies across sectors are also refining their operational risk frameworks after recent disruptions, strengthening their resilience against supply chain shocks, system failures, and even space weather events. Despite these challenges, the risk management field remains forward-looking. Leaders see opportunities to harness data analytics and AI to predict and manage risks with greater precision. Encouragingly, some insurance industry watchers predict that if current mitigation efforts succeed, the runaway climb in premiums for disaster-prone areas could stabilize by next year. These trends underscore a cautious optimism that, even as risks multiply, innovative strategies can safeguard businesses and communities in a changing world. Fintech. CNBC. Subtopic: Risk Management and Insurance, Climate Fallout. The Great Insurance Retreat. Climate change is fundamentally reshaping the risk landscape. And nowhere is this clearer than the crisis unfolding in the property insurance market of certain U.S. states. Years of record wildfire and hurricane losses have led insurance giants like State Farm and Allstate to stop writing new policies in California and Florida, fearing unsustainable payouts from natural disasters. The result? Premiums in Florida have quintupled relative to the national average, and in Louisiana they are now triple, stretching family budgets and jolting entire local economies. In California, at least 8 insurers have exited or curbed coverage due to catastrophic wildfires, forcing homeowners into the costly state-backed FAIR Plan, which has seen its policy count surge 137% since 2019. With insurers pulling back, real estate markets are feeling the heat. Deals are collapsing as buyers struggle to find affordable coverage. And even routine transactions now require securing insurance earlier than ever in the process to avoid last-minute surprises. The climate-driven insurance upheaval is also raising broader concerns for economic development. Business leaders warn that high insurance costs could deter companies from investing in communities where employees face prohibitive housing costs or coverage gaps. In response, some state governments are enacting reforms, from litigation crackdowns to more flexible rate approval, to coax insurers back into high-risk markets. While it remains uncertain when relief will come, this upheaval is spurring urgent innovation in risk management, prompting new conversations about resilience, adaptation, and how societies can share the burden of an increasingly volatile climate. CNBC. +1. In investment and capital markets, global markets are navigating a whirlwind of opposing forces, with investor sentiment seesawing amid economic data, geopolitical surprises, and shifting sector fortunes. U.S. stock indices have experienced notable volatility over the past 24 hours. The tech-heavy Nasdaq Composite sank around 1.4% as a sharp rebound in chip stocks suddenly fizzled, renewing concerns that the breathtaking AI-driven rally in semiconductor and technology shares may have overshot sustainable levels. The S&P 500 also turned downward by roughly 0.7% after initially climbing, while the Dow Jones Industrial Average remained near the flat line, buoyed by pockets of strength in older economy sectors like real estate and healthcare. Investors have been rotating funds out of high-flying tech names into more cyclical stocks that could benefit from improving geopolitical conditions, such as a potential peace deal easing Middle East tensions and lowering oil prices. The day's decliners were concentrated in big tech and AI-fueled winners. Chip makers like Nvidia and Broadcom slid after huge rallies, while more defensive stocks and value sectors saw modest gains, hinting at a market seeking balance between innovation excitement and fundamental earnings stability. Meanwhile, interest rates and inflation remain central to market direction. Persistent price increases have traders reassessing the Federal Reserve's next moves, with many no longer expecting rate cuts and instead bracing for the possibility of additional tightening later in the year. CNBC. +1. Yahoo. +1. Despite near-term jitters, capital markets continue to be energized by major upcoming opportunities and long-term growth narratives. Initial public offerings, IPOs, are taking center stage, led by the widely anticipated SpaceX listing touted as potentially the largest ever. Elon Musk's private space venture is reportedly preparing to debut on the Nasdaq later this week with an eye-popping valuation of roughly $1.75 trillion, aiming to raise around $75 billion in fresh capital. If those figures hold, SpaceX's stock market debut would dwarf all previous IPOs in scale, signaling investors' enormous appetite for space-oriented businesses and high-tech infrastructure plays. The buzz around SpaceX's listing is such that some market watchers credit it with both stirring euphoric optimism and a note of caution. Bulls see it adding fuel to the AI and space-driven bull market, while others wonder if such exuberance could mark a short-term peak in tech mania. Adding to the excitement, OpenAI has just filed confidentially for its own IPO, barely a week after rival Anthropic took the same step. indicating that generative AI companies are racing to tap public markets as investor enthusiasm remains red-hot. Together, these developments underline how capital markets are embracing frontier industries from space exploration to artificial intelligence as key drivers of future growth. Even as prudent investors remain watchful of risks amid the market's shifting winds. CNBC. +1. CNBC. +1. Yahoo. Global investors are also keeping an eye on economic fundamentals that may shape tomorrow's market trajectory. The latest data on U.S. housing and commodity prices provided a mixed backdrop. A report on May home sales surprised to the upside, suggesting resilience in consumer demand despite higher mortgage rates. At the same time, oil prices eased on hopes of de-escalation in the Middle East, which offered relief to industries like airlines and transportation while denting energy stocks. On the other side of the Atlantic, European stocks ended Tuesday mostly lower, with indices like the Stoxx 600 and Germany's DAX down modestly, but France's CAC 40 and Italy's FTSE MB managing small gains. Analysts note that, with the U.S. Federal Reserve's next policy meeting looming and inflation data due soon, markets worldwide are entering a typical seasonal calm before the storm period. June is historically a choppy month. And many traders are locking in profits from recent rallies while awaiting clearer signals on interest rates and growth. Even with short-term volatility, the broad market tone remains cautiously optimistic. Given widespread expectations of stable economic growth and the prospect that a more peaceful geopolitical climate and moderating inflation could support a renewed global bull run in the second half of the year. CNBC. +1. CNBC. +1. Subtopic: Investment and Capital Markets. SpaceX's galactic IPO ignites market imagination. Space is the next big frontier for investors, and SpaceX's imminent public listing exemplifies how capital markets are venturing beyond Earth's atmosphere. If all goes as planned, SpaceX will debut this week at an unprecedented valuation of around $1.75 trillion, making it the largest IPO in stock market history. The offering is expected to raise roughly $75 billion from investors, a staggering figure that dwarfs all prior IPO proceeds. Institutional demand is sky-high for a stake in Elon Musk's ambitious rocket and satellite enterprise, reflecting investors' belief in the vast potential of the growing space economy. Banks like Morgan Stanley, serving as lead underwriters, have issued bullish forecasts envisioning SpaceX's revenue reaching into the trillions of dollars within 2 decades, a scenario in which the company would generate more annual income than entire countries' GDPs. Enthusiasts argue that as space exploration and satellite internet services expand rapidly, SpaceX's growth could transform industries and unlock new markets, fulfilling decades-long dreams of commercializing the cosmos. While skeptics caution that such projections carry significant risk and uncertainty, this record-shattering IPO undeniably signals a watershed moment. Wall Street is not just banking on earthbound industries, but boldly funding ventures that look to the stars, blending financial ambition with the human drive to push new frontiers. Yahoo. +1. Crypto Briefing. In AI and data analytics in finance, artificial intelligence has swiftly moved from buzzword to bedrock within the financial sector, fueling innovation and spurring competitive shifts in strategy. Across global banking and capital markets, leading institutions are now placing AI and machine learning at the core of their operating models. In fact, this year's Global Finance Innovator Awards highlighted that top banks worldwide are leveraging AI not as a side project, but as a primary engine of efficiency, client service, and decision-making. Spain's banking leader BBVA, for example, uses advanced AI algorithms to make customer interactions faster, smarter, and ultra-personalized, aiming to deliver tailored financial advice at scale without sacrificing trust and human touch. BNY Mellon has integrated AI with cloud computing to unify vast troves of investment and accounting data, achieving more seamless processing for clients. while DBS Bank pairs AI-driven automation with human expertise to eliminate low-value manual tasks and free employees to focus on high-margin advisory and risk management work. As one executive noted, the true measure of success is whether AI frees up our people so they can focus on higher-value work, reinforcing that technology in finance is ultimately aimed at empowering human potential and better serving customers. FMAG. FMAG. +1. Financial firms are also embracing AI to deliver more personalized and accessible services to everyday consumers, even as they grapple with the need for transparency and responsibility. In the UK, for instance, banks are capitalizing on the country's advanced open banking framework, which allows customers to securely share their financial data to power new AI-driven tools for budgeting, saving, and credit decisions. A recent report found nearly 1 in 3 British adults use some form of AI each week to manage their money, whether via chatbots that help interpret spending patterns or smarter apps that highlight better financial products. These technologies promise to make banking more accessible, faster, and even more personal, as AI can sift through data to offer tailored financial insights at scale. However, industry experts caution that this convenience must be paired with accountability. If customers receive decisions from algorithms that they don't understand or can't challenge, then smart finance could become just a faster way to confuse or frustrate people. Regulators like the Financial Conduct Authority emphasize that banks must ensure fairness, clarity, and human fallback in AI-powered services, so that innovation truly improves customer outcomes rather than sacrificing them for efficiency. The conversation. +1. The conversation. On the operations side, the marriage of AI and data analytics is transforming how financial institutions manage their internal workflows and compliance processes. Beyond basic chatbots and predictive models, firms are pioneering agentic AI systems that can orchestrate complex tasks across various business systems while preserving strict controls and auditability. For example, telecommunications giant AT&T disclosed a cutting-edge project in its finance division, an AI-driven agentic workflow that interprets accounting goals, autonomously gathers and reconciles data from multiple sources, prepares draft journal entries under Sarbanes-Oxley (SOX) compliance rules, and then routes them for human approval with full transparency and audit trails. This innovative approach demonstrates how AI can be woven into high-stakes financial operations without sacrificing oversight, as each step of the automated process is carefully monitored, documented, and subject to explicit human sign-off. Such examples show that in heavily regulated fields like banking and finance, the real value of advanced AI lies not in replacing humans, but in augmenting them. As these technologies mature and scale, they hold the promise of boosting productivity and accuracy, reducing mundane workloads, and enabling finance professionals to focus on strategic, creative, and empathetic roles that drive long-term value in our increasingly digital and interconnected economy. The next web. +1. Subtopic: AI and Data Analytics in Finance, Human plus Machine, Banking's New Synergy. Forward-looking financial institutions are betting that the most successful models will combine artificial intelligence with human expertise to enhance client service and performance. At BBVA in Spain, Global Head of Data Antonio Bravo describes the bank's strategy as leveraging AI for speed and personalization while preserving the scale, trust, and the right support at the right moment that human advisors provide. Rather than choosing between artificial intelligence or people, BBVA's model blends the two, with algorithms handling routine inquiries and data analysis to tailor offerings for millions of customers, while human bankers focus on complex and high-value advice. Likewise, at BNY Mellon, machine learning and cloud technology fuse diverse data streams into unified client portfolios in real time, allowing faster decisions and better risk controls. DBS Bank in Singapore is harnessing AI to automate back-office tasks and fraud detection. But top managers there stress the priority is to relieve employees from repetitive chores so they can devote themselves to higher-margin advisory roles and human-centric problem-solving. This people-first deployment of AI is becoming a hallmark of the financial sector's futurist yet realistic approach, using technology to improve efficiency and accuracy while enhancing the human elements of trust, judgment, and empathy in financial services. In the long run, an AI-augmented workforce could help banks and investment firms serve clients more holistically, ushering in a more personalized and productive era for global finance. FMAG. +1. SpaceX's record-breaking IPO steals the spotlight. Nothing in this report is legal, medical, or financial advice. This is news and commentary only, and any anecdotal stories should not be treated as professional advice. Video description. Today's edition of Enterprise Finance Daily dives into 5 major financial sectors with a futurist lens. We cover a potential Fed policy pivot and global bank resilience, a fintech boom blending blockchain with big finance, insurance challenges in a volatile climate, stock markets bracing for a record-shattering SpaceX IPO, and how AI is transforming financial services with a people-focused twist. Each story is packed with up-to-date insights and hopeful perspectives, linking daily market moves to longer-term trends shaping the future of finance on Earth and beyond. Video tags: finance news, corporate banking, fintech, regtech, risk management, insurance industry, stock market, capital markets, investments, economic trends, financial technology, stablecoins, SpaceX IPO, AI and finance. Data analytics, global economy, banking sector, financial markets. Base thumbnail concept. A dynamic collage fuses finance and futurism. A city skyline with stock market tickers and upward trending charts, overlaid by a digital network pattern and a rocket launching towards space. This visually represents the connection between global markets, technological innovation, AI data streams, and the new space economy, capturing the spirit of financial frontiers and optimism about future growth. Thumbnail variation A. Emphasize the banking and market angle. Visual shows the exterior of a major bank building in the foreground and a rising stock market graph in the sky, symbolizing corporate finance strength and surging markets. Subtle binary code